All right, all right, all right. I've been told that when I'm using this setup, my microphone is not that good, so I'm going to speak loudly for you. So basically, listen. Here's what I want to talk about today. I'm gonna just give you guys kind of a run through on our Monday call. We're doing a Monday call. And that Monday call is going to be about Molly's going to give us the title here in just a moment when she puts up the caption. Hello, John, and also on today's 4 o'clock call that I have with my hotel to apartment cohort group. I have a big announcement. We did. A fund has agreed to provide over $1 million to our deal, and then also we have another deal that is just gone under contract for our second cohort deal, and we have 2 more where I've got to review the contracts and get them done by tomorrow. So it's going to be very, very exciting. Very exciting. And so what's happening is on Monday, I'm having a kind of a holiday webinar with my partner, David Peters, where we're going to talk about the 10 things you need to know about H2A. And on this call today, I'm just going to touch on the top 10 things. I'm not going to go into detail. That's what Monday's for. So why don't you just sit back and let me just kind of share with you some of the 10 things that you need to know about converting hotels to apartments. Now, these are the things that we teach over our seminars. We go into very, very granular detail on most of these 10 things. But on Monday, we're going to be talking about them just to get your mind thinking about what you can do and maybe what you feel you're not qualified to do. And then you need some partners to be able to help you out. And that's where we come in. So let's talk about it. And so coming in at number 10. Okay, preferred returns. Guys, we just raised $1.5 million without offering preferred returns. And here's why. We're converting a hotel to an apartment. So there's a huge renovation process. We're not looking to give away our money during that renovation process. We know that the money is so much better off plowed back into the deal to increase the velocity of the money, and we can get out faster. So we do not offer preferred returns, and our investors have no problem with it. Number 9. What type of financial benchmarks should you expect? Now, what I'm talking about here is what type of internal rate of return, IRR, what type of cap rates, what type of multiples of your investment should you expect in these types of deals? We're going to talk about that so you can get a better handle on what you're seeing. Now, let me just throw out an aside here. This is a great conversation I had with one of the fund managers that we're working with. And they said that when they were offering a deal and they were offering a 24% IRR, they had trouble raising money. When they dropped that IRR down to 17, it filled up in no time flat. And here's why. Because at 24, it looked like it was one of those get-rich-quick schemes. And most savvy investors, 17's nice, but we want security. 24, too pie in the sky. And when they reduced it, everybody came in and joined. When it was said and done, they got well over 24. So I'll tell you with some of the benchmarks that we use, we are incredibly conservative in them, because even our projections are above what we've been able to perform with. So for that reason, it's pretty cool. All right, number 7. Where is that? Right there. Oh, very important. The experience of the sponsors. We're finding this to be very, very important. And a lot of these lenders, because we still have to go through debt, we still have to secure debt. They want to know what has been the experience of the people in the group. And the problem with hotels to apartments is not many people have done them so far. A lot of people have acquired multifamily property, but how many people have gone full cycle in a hotel to apartment conversion? We have. It's very exciting, very exciting. So this is what kind of sets us apart from a lot of these people. Number 6. Oh, the current status of the property. All right. Now, I don't remember, Molly. You see, because they're bullet points. I'm just giving you the topics. So let me talk to you about which this is about. And I'm not quite sure what it's about, because it could be about 2 things. It could be about the current zoning status of the property and whether it's zoned by right as a hotel, like that has sleeping occupancy rooms, or if we can convert it easily and zone it by right as a multifamily, have more dwelling occupancy rooms. This is something that you always have to go in. Molly. Dang, that girl's good. So the current status, how old is it? If it's too old, like if it's too old or if it's too new, it's no good. Honest to God, that may sound crazy. Yes. If it's too new, it's just not a conversion opportunity. If it's too old, why bother? There's so many good opportunities, and the opportunities that are out there are growing. Because as these things get older and the hotel operators want to move on to bigger, better things, that becomes a great opportunity to convert. And that's why some of these properties out there that were built in the last 10 years, they're getting too old and they're becoming perfect opportunities. Does it have sprinklers? If it was built before 1980, forget it. Usually around 2000, you're seeing that all the rooms are sprinkled. Well, if we're going to do the conversion, the town is going to want sprinklers. That's a lot of money. So we try to find ones that already come with the sprinklers. Electrical panels. When we turn these things into individual units with their own cooktops, their own microwaves, they have to have their own electrical panels. So they blow a fuse. Nobody has they don't blow out the whole wing. And that's part of the problem. And then all the square footage of the rooms. If it's too small, below 300, not something we'd be interested in. We're looking at one right now. The one that we just got under contract, it's about 100-unit property. They have about 27 units with that are around 550 square feet. Wow. Guess what that is? That's not a studio. That's a 1-bedroom. And that's exactly what they are in this hotel. So we think this particular deal that we're doing now is going to be a very, very light lift. So, all right. 5, location. Very, very important. And, the thing is that what we're doing in these markets is we're converting a hotel to an apartment, but not just your typical kind of apartment. It's a studio-based apartment. One of the properties we're doing is 144 units. We're going to flood the apartment market in one fell swoop with 144 studios. What's that going to do to the market? We think it's going to be fine, because in the markets that we're in, they're very strong. They're growing. It's perfect for these types of growth. But we've looked at other properties that are 35,000 people population in these markets, and it's a 100-unit hotel. How can it even survive as a 100-unit hotel? It can't. That's why it's for sale. And then adding 100 units, studios, to a 35,000 total population area, that's not the way we want to go. So getting the location just right is part of the analysis that we're looking at. Okay. Hey, Tyler, I'm going to come back to that in just a moment. That's a great question. All right. What's the number 4, Molly? Where am I? There. Physical conversion. Oh, boy. Listen, we're going to get deep into this on Monday, but physical conversion, what we're looking for light lifts. That's the name of the game. Is it a light lift or is it going to be a tough conversion? Tough conversion are we have to put in all new electrical panels. We have to put in sprinkler systems. We have to, we have to do a lot of, begging and pleading with the zoning board to get this thing converted. All new kitchenettes, all new. That's a heavy lift. We're looking for properties that are easy lifts, that are already studio hotels, that we can just go in there and really turn them around and make them look great. One of the properties we have is a true C+ class property in an A area, and they already have kitchenettes, and we're going to make this place shine, and that's going to be a light lift. We think we can get in and out of that property in about 18 months. So that's definitely a home run in our book. The other one is 96 units and 26 of them are one bedrooms, or all the rest are studios. It looks like an apartment building. Those are perfect conversions. And here's the thing, folks, there are so many of them out there. And more of them are coming online to the conversion world every single month because they're building new hotels, and the ones that they built 10 years ago are obsolete. And those are the ones that we want. Those are the ones we're going after. All right, Molly, number 4, zoning issues. Here's the expression I want you all to understand. It's called zoned by right. That means by right. I have the right to build an apartment building in this zone. Well, that's not always the case. You might think, hey, it was a hotel right there. I'm just going to go in there and convert it to a multifamily. No, it doesn't work that way. It's a totally different zoning issue, and you need to understand that, because some of the things you need to think about when you're looking at the zoning is, guess what? It is zoned for residential. So is that good? Well, not exactly, because you have to ask the further question is, well, how many units, how many dwelling units can I have per acre in that area? We had the one with 144, we were right at the cusp, but then you can read down deep into the zoning laws of that particular jurisdiction, and you'll see that there are exceptions. And one exception allowed us to put in up to 450 units. And so therefore, sometimes the exceptions are studio apartments. They allow more in those areas. The other nice thing about studio apartments is that they tend to allow you to have 1-for-1 parking, and just like a hotel. And parking is always a zoning issue that you always have to take into consideration. There are other things you need to look at. Listen, one thing I learned in law school, there's an exception to every rule except for one. All right. Here was the exception in this particular city. We didn't have to comply with the parking requirements, the parking ratios on this particular property if it was on a bus line, or if we built there's little parking stands for bikes. No joke. If we had those, we could change our parking ratio. So that's definitely something you need to understand with the zoning issues. Number 3, boom, conversion strategy. Okay, so each one's different. Now, I'll tell you, my partner David has done about 5 to 7 conversions. Each one of them ended up having a different conversion strategy. When he went into them, we're going to convert these all to multifamily. When he got done, not all of them could be converted to multifamily, but they were still cash cows. And, then that's what we call a hybrid hotel, where we've got some short-term rooms, we've got some long-term rooms, we've got some sleeping occupancy certificates, we've got some dwelling certificates. It really depends, and you have to work with the city. So as soon as you get a deal under contract, the first thing you're going to do is find out who the best zoning attorney is in that area, so that you can start mapping out what your conversion strategy is going to be and how these things are going to look when you're finally done with them. Okay, so that is the best strategy to have, is just keep things open. okay, let me give you a little inside baseball. When you're negotiating with the broker and the seller, don't tell them you're in there to convert. Your price will go up. Tell them you're going to go in there and run it as a hotel. But I just got off the phone with one of my students, and he got a deal under contract. And he says, I got this form from the zoning department. It says we can ask the zoning officials what we could put in this particular area. Should I tell them? And I said, hell yeah. Those guys, they're the final rules maker on this thing. So we want them to know this is what we're looking to do. Can we do it? Because we can't pull out any fast ones. Them with the seller, we didn't want him to know because we didn't want to pay more for the property. So that's the deal. Now, all right, Molly, boom. Understand the investment. Okay, so here's part of the deal. You got to understand, what is it you're exactly trying to do here with this particular property? What's the long-term hold? Are you looking to get to a certain point where you can do a cash out refi or some type of a capital event and therefore pull your money out of the property, pay off all your investors, and you continue to own it and operate it? That is definitely a great strategy to have, but make sure that when you're putting together your PPM and you're selling this to the investors, they all understand, hey, this is a short-term hold, 18, 36 months, and then you're going to get all your money back plus the profits on the back end. And then we're going to keep the property run. We're going to keep running the property. So that's part of the strategy is understand the investments and what your long-term vision is. Because there was a guy, his name is Stephen Michaels, I think his name. He was just recently on a podcast with Tim May. And he's a hotel converter, and I love what he's doing. I love his strategy. And his strategy is to cash out refi, pay off your investors, continue to own and operate the property, grow your portfolio to about 2,000 units, and then you can sell it, or you can work with an institutional investor who will refinance it for you. But either way you go, that's a great strategy and a great way to get your money out of the deal and make even more money. Okay, I think we're down to the last one, right, Mo? Exit strategy. Oh, I think I kind of just touched upon that one a little bit. You got to figure out what your exit strategy is on the property. So, so these are. I think I've touched upon that. Exit strategy is always a lot of fun. Remember that I always teach my students that when you're looking at a deal, you got to be able to answer two questions. Number one is, what's my exit strategy? And number two is, how do I get this deal financed? And that's pretty much where we are right now with our investors. We know exactly what our exit strategy is going to be on these deals. And right now, make sure Molly puts the StreamYard link right in there. Yep, there you go. So you can go click on that and register for this event. David Peters and I are going to be doing this on Monday. Don't know what time. I'm sure the link is going to tell you. They just tell me when to show up. Make sure you sign on up. Would love to have you. 10 a.m. Eastern. 10 a.m. Eastern. Good. Thanks, Mal. So I got to get up. Well, I'm going to be doing that one from the home studio on Monday because it's a holiday, right? Isn't it? Of course it is. President's Day, isn't it? Or have we changed the name of that one too? Oh, you. All right, let me see. I got this question from Tyler Glenn. Let's put it up here. Tyler, what are your thoughts on seller financing? Is that something that may attract you to a deal, even if other things do not add up? Tyler, seller financing is a red flag in my book. It really is. It means there's something wrong with the property that the seller has to remain involved in it just to be able to get out. So I always question seller financing. And I tell you, I know about one particular deal. They just did seller financing. And originally, the seller financing was for 1 year. Oh, I said, don't you dare, guys. You guys are going to get hung out to dry on that one. That is such a racket. That's when you see a seller doing seller financing for 1 year, that's a guy that lives off the down payments that he continues to collect. So they were going to have to put down $1 million and the guy was going to finance it to them for 1 year. Let me tell you about owning a property. First year is the toughest. And you got to move fast. There's no possible way that you can refinance a property and get in and get out in a year. And here's why. First 3 months, you're just getting the honeymoon. You're in the honeymoon phase. You're just trying to get used to how that property runs. Then you're supposed to rehab that property over the next 6 months so that you can get all the units ready. And then you got 3 months to refinance, because remember, the banks want to see 90 for 90. I mean, this is in the multifamily world I'm talking. 90 for 90. You're not going to be able to accomplish that in a 1 year time frame. That's why it's absolutely ridiculous. On one of our properties, we're expecting to be out of it in 18 months. We already have the schedules. We've got all the money lined up. We're buying the boxes for the kitchens and the bathrooms, and we've got it all lined up. We're going to do, quarter, in 4 sections. We think we can get that deal done, but we're giving ourselves 6 months to lease the place up. But we're going to start leasing that property up as soon as we have one unit ready, one show unit ready. So you've got to look at the terms on the seller financing, and you got to ask yourself the question, why does a seller have to remain in this deal? Is it really that bad? The banks won't even touch it. So be very, very careful. 36 months is the shortest period of time you should do any form of seller financing. 5 years would be even better. You got to make sure in those situations when you're using seller financing, you've hired an attorney to represent you during that transaction, during that both the negotiations and also the closing, because you want somebody on your side that can look over your shoulder and make sure they're drafting the note and the mortgage document correctly. That's the best advice I can give you regarding seller financing. So President's Day, good. Thank you, John. All right, how does that sound? Does that everybody understand that? Does that, Tyler? Let me know. Thumbs up. Does that answer your question? I love that question too, by the way. I've done that so many times. So I've been involved in, even for my clients, seller financing. And I just say, listen, why? What's the deal? Because you can't qualify because you don't have, like in our particular case, one of the biggest stumbling blocks, the roadblocks to getting qualified is the sponsors and making sure the sponsors have experience. We got that covered. So in that regard, we don't have to rely on seller financing anymore. But the last thing you want to do is get yourself into a seller financing deal and find out you can't do it because you didn't realize how tough it is on how tough it is on the back end to get these things done. And Tyler, if let me see if I can post something here. Tyler, if you want to share with me the terms or anything, I'm giving you my email right now. Just feel free to send me an email and ask me the questions, have me look at the deal. I'll be more than happy to do that for you because I don't want to see you get screwed, Tyler. This last deal that I saw, even at 3 years for the seller financing, they ended up doing it. I wouldn't have touched that one. I wouldn't have used other people's money on the deal. Let me put it to you that way. I think that was pretty risky on their part. They thought it was great. It was fantastic. It's great. Hey, I honestly, I hope it all works out for them. I really do. I don't want to see anybody lose money. But man, we are in a business, and all business it takes on risk. It's the smart business people who do everything they can to minimize that risk to succeed. And seller financing is a risky venture. So that's what I got. That's what I can say about it. So, all right, everybody. Thanks, Tyler. I'm glad you liked that. That was good. All right, everybody. Good to see you all. I have to get ready for my 4 o'clock call with all my cohort members because we have a lot to go. A lot to go through. So, all right, folks, I will talk to you all soon. Take care.